Hey there, awesome accounting student. Mark Franke here. This is Counting 100, Chapter 10. We're going to talk about payroll. Payroll, of course, is what we have to do when we hire employees in our business, and it really is no different than hiring a company and an accounts payable system. This is going to be a wages payable system, if you will. But in the situation where we're actually hiring people, employees, there are special rules we have to follow, primarily related to withholding of taxes and different things that we will owe to the government. So, how do employees earn money? Well, we can have different types of wage earners in our business. We could have people who are salaried employees. Those are usually management or manager types. We can have hourly employees who punch a time clock or fill out a time card or some sort of timekeeping mechanism. We can have contract employees. It could be like a sports team has contracts with all their athletes. We could have people that earn commissions, or we could also have people that earn tips if we're in the hospitality industry, the restaurant, or personal services. We could have a bonus that we pay every quarter or at the end of the year or Christmas time or something like that. Now, we also can pay overtime, and the rules are, the labor laws say that if you work somebody more than 8 hours a day or more than 40 hours in a week, you have to pay them overtime, unless, of course, you adopt a 4-10 work week, but that's a different issue. Or we could even have people that make piecework. Piecework is in the garment industry. If you are sewing soccer shorts or something like that, you get paid by how many you produce. Regardless of how we pay people, we have to guarantee minimum wage. So that's just a separate calculation. If they're not producing enough, for example, in their piecework, we still have to pay the minimum wage. Now, we can have different types of pay periods, like daily. That's not particularly practical, but it does happen, particularly with casual labor. We could pay people weekly. That's kind of common in the retail world. We can pay them bi-weekly, which is every 2 weeks. Or semi-monthly. Semi-monthly is twice a month. Bi-weekly and semi-monthly are not the same. Bi-weekly, there are 26 pay periods in a year. Semi-monthly, there's 24 pay periods in the year. We could pay people monthly. I'm a professor. I get paid monthly. But in a private industry world, you can't pay people monthly. You have to pay them at least twice a month. But because I work for the government, and the government does do monthly because they, like the Army or the military or even federal workers. Now, other things we could do is pay quarterly for like bonuses or commissions or something that's not their regular pay. And then we might even have an annual thing. But regardless, we just have to figure out how much somebody earned during a particular pay period. And that's going to be gross wages. Then from the gross wages, we have some mandatory deductions. These are deductions that you have to take from employees: federal income tax, Social Security tax, and Medicare tax. Those are requirements that we withhold this money from the employee. Remember, the employee is paying this money, right? They earn a certain wage, but then we withhold this money and we create a liability. Now, employees may also have an optional stuff for health insurance or 401k contributions or savings plans or cafeteria plans, all kinds of other ways that employees can contribute towards their retirement or towards childcare, whatever it is. So, but the calculation ultimately is the wages minus these deductions gives us the net pay. And so from an accounting standpoint, when we accrue the payroll, when we calculate payroll for a period, we calculate the gross wages. That becomes a debit and to an expense account. It could be one expense account for wages expense, or it could be multiple ones if we have different categories of wages, like warehouse wages or sales wages or administrative wages or something like that. And then each one of these withholdings becomes a liability. So that's a credit because we have to pay this money to the government. And then we create a wages payable credit, which then when we actually hand out paychecks, we relieve that with a debit, and then we credit cash. So that's how this works. Theoretically, let's do a problem. This is problem 10.3b. And we have 4 employees. This is the Merino Consulting Service, and we're going to complete a payroll register. I've given you a worksheet that you can either use and fill out in pencil, or you can do this in Excel. But this is basically a list of the information in the textbook. So this was just provided by the problem in the textbook, which is on page 352. So the first step is to, and just to walk through, we have the name of the employee, the number of allowances. This is in the book on a sheet that we have to follow, because if they're married or single, it's going to be a different sheet. We want to track their cumulative earnings. That means that the earnings that they've earned before this pay period. Then we have their regular hours and overtime hours for this pay period. And this is, by the way, the pay period for the week ended November 12th. And then their pay rate. So this is information that's right from the book. And you can see it and tie it back. So first step is to calculate their regular earnings. So the regular earnings is going to be the regular hours times the pay rate. Makes sense? So for Catherine Allen, and by the way, I have done this in a column form. The way it's presented in the book is in row form. It doesn't matter. It's the same information. It's just easier in Excel for me to present this in front of you if I do this in employee columns, and that way I can just go straight down. But it's the same thing if we're going across instead of down. So hopefully that won't freak you out. Overtime earnings is going to be the overtime hours, which is 3 times the rate times 1.5, because we're going to pay 1.5 times for overtime, and that's $47.25. So if I add the regular pay and the overtime earnings, I get gross pay for Catherine Allen of $467.25. Calvin Cook, we will multiply regular hours times the rate, $369. Calvin did not have any overtime, so that's $369. So go ahead and do the calculations for Maria and for Holly, and you can pause the video and I will do them, and you can compare. I'll be right back. Okay, I'm back, and I've totaled up the regular earnings, overtime earnings, and the gross pay. 3608.50. 3608.50 is what you should have gotten. So hopefully you got that. If not, pause it and go back and check and see where you went wrong. Then, if I add together the cumulative earnings before this pay period, which is up in row 10, with the earnings for this pay period, I'm going to get a new amount of cumulative earnings, $27,032 for Catherine, and I'll just go ahead and copy it across. I know Excel is a lot easier than with a pencil, but that's okay. So we have new cumulative earnings for each one of these employees, the total of $214,232.50. So now we need to also figure out taxable Social Security. And for every single one of these employees, because the wage base is much higher than any of their cumulative earnings, that's why we're tracking this. Because if they hit that maximum amount, which is $132,500. $132,500 is the maximum amount that you would pay Social Security on, but none of these employees are even close to that, so we don't have to worry about that. So what that means is that their current gross pay is going to be the same as both taxable Social Security and taxable Medicare. So I'm going to just copy these guys across, because whatever their gross wages were for this pay period, they're going to be exactly the same for taxable Social Security and taxable Medicare. And because the wage base for FUTA, every one of these employees is over that amount, there is no FUTA wages. But if they were underneath it, and I'll just put zeros all the way across here, there's no FUTA wages, which is federal unemployment tax. So now we've got the gross pay, and I'm just going to link it in from above, because now we're going to actually do the calculation of each one of their paychecks. So we're going to start with gross wages, and then we're going to calculate Social Security tax, Medicare tax, and income tax. So Social Security tax is the wages times 6.2%. So if I take gross pay times 0.062, I'm going to get the Social Security tax for Catherine, and then Medicare is at 1.45%. These percents are in your book. That's $6.78. And so I'm going to stop the video. I want you to calculate it. Again, 6.2%. I'll put this in right here. And 1.45% for Medicare tax. Make those calculations, total it up, and I'll be right back. So pause the video. Okay, I'm back. I made a small change, of 1 penny change to the gross pay because of the total, because of a rounding issue, but that's okay. It was only off by a penny. And here's the numbers for Social Security and Medicare tax that hopefully you were able to calculate. And now we can do the income tax. So there is a table in your book. Let's see. It's on page 3. It's on page 332. 332. So for Catherine, if you look on there, Catherine is married with 3 allowances. Married with 3 allowances. If you go to the schedule, the tax table, and look at where she would fit at $467.25, you'll see that the federal tax is $13. Because they only gave you a piece of the tax schedules, they had to give you Maria and Holly. Maria is $192. This is just right in your book, and $267 for Holly. But go ahead and see if you can figure out what Calvin's amount is, and then put it in and total it up. I'll be right back. Did you get $22 for Calvin? And $494 for everybody? Good. Check it again if you didn't. And then we need to calculate the net pay. The net pay is the gross wages minus Social Security tax, minus Medicare tax, minus the income tax. And for Catherine, that's $418.50. For Calvin, it's $318.77. So I'll pause the video, calculate it for Maria and for Holly, and I'll be right back. Okay, so total net pay should be $2,838.45. Again, if you didn't get that number, pause the video and go back and fix it and see where you made your error, and then you'll learn. That's good. Okay, so we have two categories of wages, office wages and consulting wages, and they told us that Catherine and Calvin were in the office, so we're going to just bring the gross pay down from up above to facilitate our journal entry. And then the consulting people were Maria and Holly. So we'll bring down their gross wages, and then we'll total this up, and we'll see that we've got $836.25 in office wages and $2,772.26 in consulting wages. And that will just facilitate our journal entry. Because now we've calculated the payroll, we need to record it into the general ledger. And we'll do that here in a journal entry. So we're going to date it on 11/12/2021. We are going to debit office salaries, expense, and consulting salaries, expense. And I'm going to have to make this bigger so it's easier to see, but hopefully you have those numbers down below. And there's our two debits. And I'm going to link those to the two columns we just set up for the office wages and for the consulting wages. So there's our debits. And then we're going to have 4 credits. Social Security payable, Medicare payable, income tax payable, wages payable. And I'm just going to link those to our totals that we have down below. Social Security was $223.73. Medicare was $52.33. Income tax was $494. And the net pay, which is wages payable, is $2838.45. So there's our journal entry, and we will describe it as to record payroll for the period or something like that. And then they told us on the 15th, they paid the payroll. So that's the day they actually handed out the paychecks. So they accrued the wages as of the 12th. That's when the pay period ended. They collected the time cards and did all the calculations. And then when they handed out the paychecks was 3 days later on the 15th. We debit wages payable. That's going to make wages payable go down. It's a liability. It's going to go down with a debit. And then we're going to credit cash, which is going to make cash go down because we handed out the paychecks. And that is to record payment of the payroll or something like that. Now, just with the same thing, if we were going to pay the government for the Social Security or the Medicare, we would just debit those accounts and credit cash, or the federal income tax. Anytime we set up these liabilities, they're just like accounts payable. If we pay them, we debit the payable and we credit cash. Okay, so that's it for this problem. And for payroll in general, I would do this problem over again. Check your calculations. Make sure everything is cool. And then start on problem 10.3a, which is the same with different numbers. All right, thanks for listening. I'll see you again next time.